Hey guys, Felipe here. I hope everyone's doing good. As you know, I'm here to keep you up to date with current market news and teachings. So I'm going to go ahead and jump right into what I've been seeing, right? Which is specifically New York Community Bank, right? So kind of crazy this keeps popping up, but the regional banks seem to be in trouble because of commercial real estate, right? Because regional banks typically are the biggest investors in commercial real estate. So New York Community Bank Corp plunges 37% after dividend cut. That was a big reason why the stock plummeted so much. They reduced their dividend by something like 70% or something like that. So basically, NYCB reported a net loss of 252 million for the fourth quarter. It also slashed its dividend, which that was basically some of the reasons why the stock just freaking got hammered, right? It also has higher potential credit losses expected over the next year. So they're accumulating a lot of provision for credit losses, which is basically what banks or companies do when they assume or presume or foresee future borrowers of loans not making their payments, right? So they're basically preparing for what might be potential losses in a lot of the loans they have issued out. It also has higher potential credit losses expected over the next year. It pointed to two office loans in different parts of New York State. It most notably bought Signature Bank assets, some of its loans and deposits, not as commercial real estate loans in the last year, right? From the FDIC after Signature failed, which is in a way that's a good thing because they didn't acquire the bad loans that kind of caused issue for New York Signature Bank, but they literally absorbed New York Signature Bank. And they also bought a Flagstar Bank in 2022. Here it states, I would point out, though, the other banks have had net losses for the quarter. Those have been bigger banks, and largely investors haven't cared. So other banks have not been performing well, but their stock price haven't gotten hit like NYCB Bank did, which is interesting, right? Although I'm basically seeing issues in the regional banking industry overall, right? So basically, this seems to be spreading globally. Where here you can see Japan's Azora Bank hits near 3-year lows as bad U.S. property loans prompt loss forecasts. So basically, Azora, which is a Japanese bank, has exposure to the United States real estate commercial market, also got hammered recently, along with NYCB Bank, right? So basically, the Tokyo-based commercial lender said Thursday it expects now to post a net loss of 28 billion Japanese yen for the fiscal year ending March 31st, which we now have a lot of earnings coming up for the regional banks. So it's going to be interesting to see what's going on there overall and how that might affect, the overall U.S. economy, right? Specifically the commercial real estate market, which I feel it's going to probably blow up pretty soon in the near future. So this is basically just another bank that has recently gotten hammered because of the expectation of commercial real estate loans in the U.S. potentially going bad, right? So let's actually jump in to the numbers and see what's going on. So after seeing this, I was like, oh, NYCB Bank looks like an interesting potential opportunity, but it is very risky, right? Because they've recently taken some pretty decent losses and they're accumulating a lot of funds in the expectation of future losses. So they're basically saying there's trouble ahead, right? But overall, their capital position seems to be good. Common equity tier 1 ratio, 9.10%. Tier 1 risk-based capital ratio, 9.67%. Total risk-based Capital ratio 11.82%, leverage capital ratio 72.8%. So their capital position seems to be healthy, and here you can kind of see the measurements. The minimum regulatory requirements for classification as a well-capitalized institutions are a common equity tier 1 capital ratio of 6.5%, a tier 1 risk-based capital ratio of 8%, a total risk-based capital ratio of 10%, and a leverage capital ratio of 5%. So you can kind of see basically all of these ratios are above the standard, right? Or what the regulatory or regulators basically set for these banks, right? The super interesting thing, so here basically they go into the acquisition of New York Signature Bank, I believe. So for the year ended December 31st, 2023, net interest income increased 1.7 billion to 3.1 billion. The year-over-year increase was primarily the result of the Flagstar acquisition, which closed in late 2022, and the Signature transaction, which is they acquired New York Signature Bank, which closed in March 2023. This is basically some of the losses they've had in some of the loans, the increase in primary attributable to higher net charge-off, as well as the addressed weakness of the office sector, potential repricing risk in multi-family portfolio, and an increase in classified assets. So they also basically lend out for multi-family homes, and of course, office buildings, right? Commercial real estate, which they're saying is in trouble, right? So fourth quarter net charge-offs were primarily related to two loans, which that article kind of spoke about. These two loans accounted for the bulk of the 185 million of net charge-offs we took in the fourth quarter. So that's basically the hit they took. And then this is what's kind of interesting. For the year ended December 31st, 2023, the provision for credit losses totaled 833 million compared to 133 million for the year ended in December 2022. They are accumulating a ton of funds in the expectation that they're going to have to need them because they're foreseeing a lot of loans going back. That is interesting to see, because it's also what a lot of other commercial or regional banks are doing, and even globally, right? The Japanese bank I just shared with you is doing the exact same thing. So this is a global issue where global banks pretty much are, preparing for some pretty ugly issues to arise in the commercial real estate market in the US. So overall, basically, other than, so what is New York Community Bancorp? Basically, it is the parent company of Flagstar Bank, which they acquired last year, one of the largest regional banks in the country. Flagstar Mortgage operates nationally through a wholesale network of approximately 3,000 third-party mortgage originators. They have a ton of branches all over the place. Some of their loans are including multifamily lending, mortgage origination and servicing, and warehouse lending. They specialize in rent regulated non-luxury apartment buildings in the New York City market. Flagstar Mortgage is the 7th largest bank originator of residential mortgages for the 12 months ending December 31st, 2023. While we are the industry's 5th largest subservicers of mortgage loans nationwide, servicing 1.4 million accounts with 382 billion in unpaid principal balance. That's a lot of loans. Additionally, the company is the 2nd largest mortgage warehouse lender nationally based on total commitments. This is basically heavy commercial real estate investing bank, right? And they are preparing for some crazy wild rides in the commercial real estate market in the US. So that kind of gives you an idea that the US commercial real estate market's in trouble. I always like pointing this out. Banks own bank-owned life insurance. So banks are investing your money because it's what you deposit into the bank, right? Into bank-owned life insurance, you should get some for yourself, right? So other than that, financially, they look healthy, even though they recently took a pretty decent loss from certain loans that went bad. So this is for the most recent financial result, net income loss of $252 million. But prior to that, they've been pretty profitable. But what does this mean? Does this mean that further along in the future, this bank is expected to see more losses compound over potential commercial real estate loans going bad? Because after all, they are setting aside a ton of money in the case that that happens, right? So basically, here it is, provision for credit losses has increased dramatically from previous quarters. So this bank is literally preparing for some negative, some loans going negative in the future, right? They're setting money aside for that, which is interesting. They've set aside $833 million to meet potential negative or bad commercial loans that their borrowers might not be able to pay back, right? So that's interesting. This is a sign that the regional banking industry is in trouble because, again, regional banking banks are heavily invested in the commercial real estate market, which makes sense. Office buildings and so forth are not in that high of demand anymore because of the work from home situation and so forth. But other than that, I kind of find this interesting because it's a massive bank, right? And it just fell off of a cliff. So is there an opportunity here as an investment? Possibly. Why their book value per share is anywhere between $10 to $14. The stock, I believe, is somewhere around like $6 a share currently. Very risky because they are preparing and setting money aside for potential future commercial loans or loans they have in their portfolio to go bad. So let me pivot over here and change my screen. This is the Japanese bank I was sharing you about. They are also accumulating a bunch of cash on the side in the expectation that their US commercial loans are going to go bad. Here we have 44, I don't know what this is. This is in millions of yens. So we have 44 billion, 52 million yen set aside. Actually, it's more, 84 billion, 260 million Japanese yen set aside with the expectation that a lot of their loans in their portfolio, specifically the US commercial market, are going to go bad. They're setting money aside with the expectation that commercial loans they hold in their portfolio in the US market are going to go bad. Again, this spells trouble for regional banks in the US, which is kind of interesting, right? To see what's going on here. So they also reason why their stock tanked recently is because of their profits. They actually incurred a loss, right, in their recent filings of 24,861 million yen, as compared to prior results that have been positive, right? And they're also setting aside a ton of money in the case that a lot of their loans go bad, right? So that's very, very interesting situation to see what's going on in the regional, basically the regional banking global sector, especially banks with exposure to commercial real estate loans. Something interesting that I came across recently that I basically found super interesting, and is something that Ray Dalio always speaks about. And I love studying history because it's so interesting to see how, at least in the business world and the economic world, things repeat over and over again. So basically, the business cycle contraction of 1882 to 1885 was unusually long and fairly severe, and two relatively severe contractions succeeded one another in the 1890s. And now this is the interesting part. The decades of the 1880s and the 1890s were notable for political unrest, protests and movements, and unsettling conditions. Very similar to what we've been experiencing the last couple of years. And Ray Dalio talks about this stuff a lot. And that period of the 1800s that I just described was a period of a Great Depression, one of the great historical depressions that have occurred throughout the US, United States economic history, right? Such as 1929 to 1933, and one would say 2008. However, in 2008, the biggest manipulator of the markets of all time, Federal Reserve, pumped the market and revived the market, right? In my opinion, they are the biggest manipulators in the world of the markets, right? And they can get away with that kind of stuff because they are the Federal Reserve. With that being said, basically, I'm gonna leave you guys with a quote that I find super interesting, and it kind of ties in with what I was talking about, New York Community Bancorp, right? So, though he tends to make his initial purchase before the stock has bottomed and likes the opportunity to add to his position at lower prices, he also sleeps better at night, knowing that if there is a cliff out there, his shares have already fallen over it. And that's by Walter Schloss. It's a great market quote, and it kind of ties into NYCB Bank because they've fallen off of a cliff, right? But that doesn't mean there isn't any further risk because they are preparing for further future potential losses, right? That's why they're setting 800 something $million aside to meet those potential loans that might become adverse, right? So with that being said, thank you guys for joining me and listening to me. If I provided any value in any shape or form, please like and subscribe, and I'll talk to you guys soon. Have a good one.